Hello everyone, my name is Vikas Shukla, and in this video I'm going to cover a topic which is a little bit of puzzling. It was a little bit of puzzling for me, and that is why the market is not crashing even if it's going to all time highs while the fundamentals are not so great. I mean, for some companies like those who are positively affected by COVID, it's good. For example, Amazon is probably positively affected. Its sales has grown. Many of the online businesses like the Zoom has done better. Maybe a few of them like documents incorporation, they online signing documents, so on and so forth. There is a long list of the businesses that has been positively affected, but a lot of them are negatively affected, and in general the economy is probably not doing so great. So why the stock market has kept growing even right after the March, mid-March, all-time, not all-time low, but significantly low at somewhere around S&P, for example, surged up from 2350 to all the way to 3950, and that's significant. So, the many economists and those who have a very good grip on the economy have a good grip on it, and they understand the phenomena. But I'm going to try to break it down in a very simple form to to all a common stock investors who do not have or may not have any in-depth understanding of those macro things that's working behind it. So to give you again an idea, if you look at the Shiller's index P by E ratio, Shiller's P by E ratio actually, it's around 35 or 36 or somewhere around that. Around today, Shiller's P by E ratio is the ratio of the whole stock market, taking into account the current price and taking into account the earning over the average price earning over the last 10 years, also taking into account the inflation index. So, not to go into too much details, it's basically averages out the peaks and bottoms of the cyclic differences in the earnings, and then there's only one time it has been that high. A high value means the stock is overpriced. It has happened that in 2000, the crashes right before that, it was close to like 43, 44 around that, and this is the only other time it's that high, which means that we are potentially in a bubble. The other thing is the stock to DGP ratio. Basically, you take the total value of the stocks, which is close to like $50 trillion, and divide it with the GDP, which is close to like $20 trillion or something around that. We come to a figure. A high ratio means we are potentially in bubble. So these figures are close to either all-time high or maybe second all-time high, going all the way back to 1927 stock market crash. So the stock market has still not yet crashed, and economists are saying that it may keep going so, but there are some signs that things are changing around, and it could do so. So how do we understand it? So the key thing to first thing, a few data you need to keep into mind is that the first of them is that the total value of the stock market currently is close to $52 trillion to be exact, and I will take it like for the simplicity we can say it's close to like $50 trillion. And some of the data that I gathered was on 12/31/2020, the end of the last year, it was close to $50.8 trillion, more precise value. So currently it should be, the stock market has gone up a little bit in the last 2 months, so it should be close to $52 trillion. But I am not going to go into the very detail of it, but just to give you an idea that someone has to have the money to buy those $50 trillion. So the money has to chase those $50 trillion, and where does that money come? And just to give you an idea, the retirement fund, the assets, the 401k, the IRA, and so on and so forth, all this stock market has a total assets. The data going back to September 24, 22 says that it's $32 trillion. It could be a little higher than that since then. because some more funds may have come. But so this $32 trillion, for example, is chasing either the stocks or some other things. Where does it chase? That's up to the money managers who manages those funds. So now, where else is the money coming from? There could be hedge funds. There could be people like I and you who invest into the stock market out of the retirement account, and there could be foreign investors who could be coming in and investing into US stock market or somewhere else. So now there is one key thing that you need to notice is that there are private investors, and they can use their margin to buy stocks more than the money that they have. For example, let's say the private investors, people like I and you, we have $5 trillion in our hands and we invest into the stock market, then we could potentially buy stocks worth $10 trillion, or double the money that we have. So if you add these things up, and if you are looking at this $32 trillion here, $10 trillion here, and $10 trillion somewhere here and there, and all this adds up and make it to the $50 trillion. Now what happens is, what comes into picture to disturb this equation that is making it up and high is the treasury bond. And I will try to keep it very simple for the viewers. Is that the treasury bond is something that these retirement funds or people who buy those treasuries when their prices are low. So, and then they are paying up, and we buy it low. Its interest was high, so we as part of our overall risk management, these retirement funds or any other hedge funds or other instrument, they use part of their money to buy those bonds. Now the bonds, they were low in price. They were paying good interest rate that fought the inflation, and then a little bit more of that. Now suddenly Fed deciding that we are reducing the interest rates. So now the bonds were no more lucrative. So what they did was that they sold their bond back to the government or whoever, and then they got in their hand that cash. So now where do they take that cash? They couldn't. They had nothing better to do. So those funds were invested back into the stock market. So the funds moved away from the bonds and were invested into the stock. So that's the primary key equation we are looking at between the bonds and the stock market. So you have to understand these things. If the treasury is reducing the interest rate on the bonds, people are going to, or the fund managers are going to sell those bonds, and in that return they get tons of loads of cash, and they have to invest that cash somewhere, and that's obviously going to find the stock market. And in addition to that, the government pumped into close to $2 trillion in the COVID-19 situation that we all know about, and then it's planning to add in another $2 trillion. Now those not all of that money is used to buy goods and service. Of course, the people who are unemployed in the lower income group, they got that money, so they are going to buy goods and services of those money. But a part of that money is like an extra money for people like me who are earning good. So what I do with that money? I'm going to buy the stocks for that extra money. Now those things are going to keep the stock market up and keep going up. So an equilibrium has to reach where that extra amount of money needs to match with the prices of the stock. And if I had that all this precise data of the available funds, the total amount of the fund available and the total amount of the stock value, those things could match, and then you can very precisely predict how high it could go. So let's say all of the money available cash by after selling my bonds, after getting all my COVID-19 stimulus package and all. I add up all, and that's and we let's say we have reached that saturation or equilibrium level. There is no more extra money where it can go further up. At that point, the stock will become saturated, and it can only move side by. Probably that level has arrived. Maybe a little bit, it could go a little bit high because of the further stimulus that is coming, which can come between somewhere in the March to April. Now, once that happens, once those extra money has been is in the market, after that it will saturate. Maybe another 2 to 5% more, or probably not more than 5% from now onward. And then there's another thing that's coming, and that's something you have to be very, very careful about, and that is inflation and the increase in the bond rate. Now, as the bonds rates started climbing up, even if it's very small, from maybe something around 0.5% to climbing up to 1.5%, the money markets know that the stock market has reached their peak. They will start shifting some of the money back to the bond market. Right now, they are not doing because the inflation is, let's say, close to 2.1% or whatever, and the bonds are paying, let's say, 1.25%. So, buying bonds is actually they are getting sure negative returns. So that's why they are not doing it. The moment the bond returns become slightly, let's say, incrementally better than the inflation rate, they know that at least they are not devaluating their money. And the moment that the shift starts happening from here to here, what's going to happen? The amount of the money available has to match the value of the $50 trillion stock. So obviously, if I have only 45, I have $50 trillion stock, we have $50 trillion of money chasing these balances. Now, if I have only $48 trillion and the stock market is 50, that equation doesn't match. The stock prices has to go down. And then slowly when it starts moving, I move $5 trillion more towards the bond, then this figure, $50 trillion, has to come down to $45 trillion. So that's a very big picture that we have to be prepared in order to understand this bond and inflation and the stock market valuation. So that's a very broad picture, but looking at the individual stocks, the things could vary from stock to stock, which means that some of the stock could still be doing good when the overall market is down. Some of the stocks could be going down, but in general, if the stock market of $50 trillion, if it goes down substantially, like 10% or 5% or 20%, in general, all the established stocks, for example, Amazon, whether it's Google or Microsoft, they should come down pretty much in uniformly. More or less, some of them will be less, some of them will be more, and there you will use your own stock picking techniques or tricks. Some of them work, some of them does not work, but I wanted to give you an overall picture, and I hope this is helpful for you, and thanks for taking a look.